Hey, welcome back to the course. So in this video I am going to demonstrate to you guys how you would operate interactive brokers. So now you know the strategies we trade with. How do you actually take a trade via interactive brokers using the strategies that we trade with? So interactive brokers is definitely the broker I would recommend. There are others out there. Again, there's like TD Ameritrade, E-Trade, and so on. But I personally, there's Tasty Trade also in the UK. I personally started with interactive brokers, and I tend to stick with something that I know well, and they are really good. They're fast execution, a lot of instruments to trade with, customer service decent, and low commissions as well. So to take a trade, right, in terms of options, right, so this is the typical platform. I'm just going to move this. So, let's, whatever you're going to trade, AAPL, which is Apple, you just do a search for the ticker symbol. So once it comes up, AAPL, you buy, you sell, are you longing it? If you're longing it, how many shares you want to long, if it's 10 or 5, whatever it is, and then this is the limit price, how much you want each share to be secured at. So you put that in here, and typically I choose GTC, and fill outside RTH is basically if you're trading pre-market or after-market, you would use that and the trade will still open. But in the case that we trade, because we trade options and we swing trade them, that would never apply. And then you just submit, and that's when you would buy. So this is a demo account. I'm just wanting to share with you guys how this works. If you're using a live account, it is exactly the same thing. And if I'm being honest with you, if you're trading something and it's new to you and you haven't done it for a period of time, I would definitely recommend you to try it via a demo account. Even if you're following somebody, even if you trust them, trade using a demo account to begin with, at least for 3 months, ideally 6 months, before you judge whether it's worth doing it for real, because then it's your real money you're playing with. So in the event of options is a little bit different. You click on new window and you click on option chain. That will then open up the option chain for the stock Apple, and these are the expiration dates. When do you want the contract to expire? Typically with the alerts, or the way I trade, we typically go out about anywhere between 2 weeks up to 2 months sort of expiry, right? Never really more than that, and usually not less than that. And typically we close a trade anywhere from 1 day to 2 weeks. I don't typically hold a position for longer than 2 weeks, but usually it's always more than 1 day. Sometimes it's 1 or 2 days. Sometimes it might be 10. That just depends on when the market offers us the opportunity to exit. So that is typically an option chain. You have your calls on one side and you have your puts on the other side, and these are your strike prices. So just as an example, how we would take a trade if you're following my alerts, or if you're taking a trade on a credit spread or on Condor, I will show you. But first of all, I want to show you how to sell a put option. Okay, so a put option, in the event of a put option, right? So this is AAPL, Apple. Okay, and remember, so if we have to draw out our main key supports and resistance, etc., right? So there's obviously one. Well, in fact, let's go on the daily first, right? So, but there is one around about there, and one there. Just the key ones. You probably don't even need that one there. So just the key ones, those two, right? So you can see this is bouncing off that support there. And as a result, you might want to have $180 as a strike price. So if it was me, I would probably prefer the 160. Okay? So next we go over to our platform. So typically, like I said, I want something which, so when you're selling options, right, time is on your side. When you're buying options, time is against you. There's something called time decay, which is why I tend to sell options. I prefer selling options because we have a higher probability of the event occurring. And I'm not saying we never buy options. We sometimes would buy a call, but again, only during times that make sense, on a stock that makes sense. For example, this stock right here, NEO, which I like, buying a call option here, which means you want the price to go up, given enough time before expiration, makes sense because it's near the bottom, and if it just goes up some, you're going to make a good amount of money. However, in the case of Apple, which we're trading, well, which we're looking at the moment, it doesn't make sense. It could go up, could go down, especially when there's a resistance there, it's in the middle of nowhere. Where does it go? You don't want to guess the market. This is where we might sell a put option on it. So let's say 180 and 160, okay, 180 and 160. Let's keep those in mind. And let's go, give ourselves a little bit of time anyway. You want to give ourselves some kind of time. And let's say 36 days, just over a month, that might be quite good anyway. So let's say we were going to sell the 160 put, right? So that's only giving us 15 cents per contract in terms of income, right? So it's 0.15, but you always multiply that by 100 because it's 100 shares. That's only giving us 15 cents in income, which is very little. And 180 is going to give us a lot more, which is $100 almost, right? $93 at this moment in time if we were to sell a 180 put. So again, we go back and have a look at this. 180 put, probably worth it, because within the next month, as long as Apple doesn't drop below 180, it stays above it, and especially if it goes up quite quickly from here, we can pretty much close out the trade for a decent profit quite quickly. But if it does go down and wobble around, as long as it doesn't go below 180, what happens is that we are going to keep that entire $93 premium here, and then that's it, the end of the trade. But if it does drop below it, what we can do is we either close it for a loss, whatever that loss is at that by the time, or we roll the contract. Rolling the contract meaning that we go out further than expiry at a slightly lower or the same strike price and make more income on the next round. And if Apple then stays above that for the next round, then we profit overall, right? So there's different things we can do. Or worst scenario is we get assigned 100 shares or however many contracts you did of Apple, and you get assigned the shares and we close out the trade. But if you actually have a look at this further out in expiry, we actually gain a higher premium regardless, right? So you can see 160 we gain $26, and the 181 we're actually gain $156. So you might want to take that trade at the first place right away. Or if you're happy with $26, if you're happy with $26, you might want to take this trade right away here, because even if you get assigned shares of Apple at $160, it is a really good price for Apple because there's a key support there. So there's various ways of doing this. So that is how a put option works. And the reason we might want to do that is because we make a profit. Let's say we are choosing this strike price. We make a profit if the stock goes up. We make a profit if the stock stays the same, consolidates, and we make a profit even if it goes down, right? The only time that we are in risk or losing is if it drops dramatically. For Apple from here to drop below 160, that's like a 20% drop, right? 20% drop on Apple, if you have a look at the market cap, is definitely over $1 trillion, right? Whatever it is, you can have a look on Yahoo Finance, a couple of $1 trillion. For Apple to drop 20%, it takes a lot for Apple to drop 20%. So, it's unlikely to happen. So this is the time when we trade a put option. This is the time when we want to sell a put option. We collect that premium, and we have a very high probability of the trade giving us a profit at the end of the day with limited risks, right? Because if it does go against us, we can roll it or we can close it at a loss and make it back on the next round. There's multiple things we can do. And if you're happy, like I said, with the price here to get assigned shares, if you're happy to own Apple at $160, so what? That's a good bargain price. So regardless, it is a very good strategy to trade. So I'm going to make two other videos. One other one that's going to show you the credit spread, and one other one that's going to show you iron condor. I don't want to make this one video too long. So watch the next video for credit spread and for iron condor. And I'm also going to do something, just show you guys how to buy a call and buy a put as well. And just to finish this off, just to show you guys how this works, let's say you wanted to sell a put option on Apple for $180 strike put at this price. You then click that, and that then comes up here, right? So 180 put expiration date there, make sure it's on sell. You want quantity, how many do you want to do, and then here you just put 0.95 and change this to GTC, and then you press submit, and once you submit it, you then press this override and transmit, and you would then be assigned that position. Okay, so let me just do that. So now we've just been assigned that position. We just collected $101 for that particular position there, and now we have the position. And in order to close the position, you then right click here, close. When it comes to closing it, right, I'm closing it right away in this case. I'm just sort of showing you guys how to operate this, but when it comes to closing it, you do the same thing, except now you're buying it back. Remember, we just sold that option, so we have to buy the option back. Now what happens is that if you don't close it early, if you just wait until it expires, it's going to expire worthless, and you basically keep your entire $101 profit anyway. But let's say at one point you're up 70%, the option, let's say, because we bought it, remember we sold it at $101, but let's say you can buy it back at $20 and you're happy with that, just you can close it out then, right? So you do the same quantity here, you put whatever here this is. I'm going to put 0.96 because that's how much it's going to cost now, but in reality when we close it, it wouldn't be that price, it will be a hell of a lot lower than that. And then we click GTC.